Welcome everyone to the DC3 conference from cryptocurrencies to CBDCs, organized by ITU in cooperation with Future of Digital Currency Initiative. This session will examine the approaches of implementing interoperability for stablecoins with some use case examples. Today with you, Leyla Baghirzade, a Fintech entrepreneur and board member of Blockchain Azerbaijan, and I'm delighted to share this panel with our speakers. With Catherine Gu from United States of America. She's a global CBDC lead at Visa. She heads Visa's global CBDC program, building digital payment solutions with central banks, financial partners, and global infrastructure technology companies. Our second speaker is Alex McDougall, who is president and COO of Canada Stablecorp and managing director at 3iQ. Our third speaker is Guangbo Zhang. He's managing partner of Web3 Capital, a decentralized venture capital, backing entrepreneurs building the future through Web3 technology. And Daniel Lynch, who works for Consensys in New York, covering strategic engagements in the Americas with banks, custodians, funds, central banks, and fintechs. To properly study stablecoins, we must first define what they are. A stablecoin is a coin of one unit of an asset whose value is stable relative to a reference, which may be some units of another asset or basket of assets, or a more abstract reference like purchasing power. I would like to start our panel and to invite Catherine to speak on interoperability and cross-border transactions for CBDC and stablecoins. Please, Catherine, floor is yours.
Thank you very much, Leyla, and good morning, good afternoon to everyone here. Very nice to meet everyone. My name is Catherine Gu. I am the head of CBDC at Visa, and today I would like to share with you some of the content that we have prepared for you in terms of just thinking around this very interesting and active area of research and development around interoperability and cross-border transactions. And today, I want to actually make a link between, the relation between CBDC and stablecoins, and trying to think kind of 2-3 years ahead when CBDC also gets created into the world. What does that future of payments might look like, and how could the interoperability between different forms, factors of money, as well as cross-border between different countries might look like. So this is my topic, and we'll focus on one of the sort of applied research that we're currently developing here at Visa. In terms of the agenda for today, I will briefly just lay out the foundation just to share an overview in terms of Visa's reach around digital currency research. We're currently doing a lot of active research with our team here, and just want to highlight a few key areas. And then I will delve into this notion called universal payment channels. As I said, this is one of the applied research that we have launched last year, and it is still in active development. And I'd love to share with you some of the key technical aspect behind it, as well as just envisioning around what are some of the potential key use cases that could be possible down the road. And lastly, just share a quick resource for folks to take a look. We have more resources on the Visa website, but I will direct to you some of the useful resources here. So firstly, Visa has been focused on developing cutting-edge standards and sort of protocols for digital currency ecosystem for quite a few years now. We have been learning very closely around, all the development, whether that's decentralized ledger technology, blockchain, or kind of cutting-edge technologies that could support blockchain development. And I would say, we have a lot of different resources and active areas of research in development. And I think the motivation is actually really centered around what does the future look like? And especially if the future is composed of a combination of different new type of digital currencies, including stablecoins, but also central bank digital currencies. What are some of the key designs in which the policymakers are looking for, or potential use cases that, ideally users and merchants might be needing? And with that in mind, this is how we've been driving our research agenda. And I encourage everyone to take a look of some of these research, because we do have the white papers associated with those. And I work in the product team, and I have a team of Visa researchers who are working alongside to kind of dig into these protocols in depth. And I think, broadly speaking, there are three areas of research of keen interest from our perspective at the moment. First and foremost, being a network provider, security, resiliency, and scalability are the bread and butter of what we do. And so we continue to look into these sort of areas as we're developing kind of the next generation of payment rails. We're participating, we're supporting those payment rails to ensure the security, resiliency, and scalability aspects can be as good as the current financial infrastructure support, if not better. And then the second is kind of looking into more, I would say, a newer type of technology frontier. Again, looking at CBDC and stablecoins, I think, especially coming to CBDC, there's a lot of notions, say, around offline capabilities and such. And hence, that is a key areas of research in which we're looking at all these offline capability payment systems and how that might be facilitated, what kind of hardware as well as software would be introduced. And then, there's other areas of research, which is around cross-border payments, because we realize, as there are more number of tokens or digital currencies getting generated into the ecosystem, they actually get generated into many different types of network systems. We have many different blockchains as of today, and thousands of different tokens running on top of those. And these blockchains by default are not interoperable by nature because they have different interface standards, they have different protocols perhaps. And therefore, to imagine in the future, if some of these stablecoins, for example, are going to be used for payments alongside central bank digital currencies representing the digital fiat of those different countries, then the question is really about, from a technology angle, how would you enable different types of currencies that are running on different type of technology rail stacks to be able to get exchanged and transferred from one country over to the other one? And of course, on top of all of these, we need to think about what are the key sort of compliance and regulatory protections that you need to put in place in order to support it. So that's a key area of focus. And I think, after all of that, looking further into the sort of what we should be working on, I think privacy, for example, is a key area, and privacy probably would come in along with everything else. When you're looking at cross-border transactions, you want to preserve the privacy of transactions, but you still want to make it transparent so that, especially when it comes to cross-border regulation, it has to meet the right requirements and standards in order to, before a transaction can be completed. So all of these things are of key focus point for all of us. And today, as promised, I will go into a little bit more technical detail to share with you what we call is the universal payment channels. And, what is driving us to look into this as an applied research? Well, I think the key is really, as said, we do think that in the future, CBDCs and certain types of stablecoins will coexist in some markets or in some countries. And with that in mind, we need to think about, who is going to be providing the role of, facilitating all these sort of cross-border, cross-rail sort of exchanges of different tokens and currencies. And late last year, we actually produced this research to the public called the Universal Payment Channels to imagine the future to support between CBDC to CBDC cross-border transfers, as well as CBDC to stablecoins transfers. And you can imagine me, as a friend and family sending, a foreign exchange and stuff back to my family in a different country, or vice versa. For cross-border remittance sort of use case, there are also business use cases in which, small business or suppliers, they need to pay their suppliers abroad in different amounts. And I think, these type of technologies can even enable in the future, potentially, I think, micropayments as well in small quantities, whether it's in the same type of digital currency or in a different form, because the technology underlying that can potentially have the power to to support both large sums of money transfer, but also much smaller sums of transfer in very close to, instant payments, and also like much more efficient for cross-border transfer. So what does this technology really represent? Well, we call it the universal payment channel because I think payment channel might be familiar to some of the audience here. And payment channel really is a class of technique that is well known in the crypto world. And the reason is that, blockchain is decentralized, but it is also famous for the lack of scalability aspect because there needs to be a lot of consensus mechanism involved into that. And as a result, it pushes a lot of the, the private sector to then innovate and to think about what are some potential scaling methods that one might use. So, payment channel is a class of technique. There's also many other sort of techniques that we won't touch into, but, they're well known and plenty of research and resources to look into. But looking at payment channel, this is how we imagine what the future might potentially look like, which is for each respective central bank, perhaps they have their own sort of CBDC rail that might be built on DLT networks. And for the universal payment channel, our first task is to tackle the interoperability between a DLT to a DLT network. And so imagine two central banks having two DLT networks, and on those two DLT networks, you will be building the CBDC system. And on top of that, this is where the CBDC gets created and minted. Now, you want to do the transfer between one CBDC token to another CBDC token. Instead of directly between one rail over to another rail, what you could imagine is that there is a hub that sits in between, and the hub connects into these two respective network through the establishment of what we call the payment channel. And the payment channel can be created in a very secure fashion by leveraging cryptographic primitive as well as smart contract to make the money programmable. So that what payment channel actually enable on the back end from a technology standpoint is that, prior to any transaction to take place, you do need to pre-deposit a certain number of collaterals into those payment channels. And those the fund will be locked up in the smart contract, which is governed by the smart contract securely, provided that each of the respective party can securely custody their own private keys. But essentially, the money can then pre-deposit or pre-funded into the payment channel. And once the payment channel is live, the two parties can then do transactions off the blockchain. And this is the way to really kind of skip the limitation around scalability issue, because scalability issue happens when transactions try to happen on chain and you need to involve a lot of consensus mechanism. However, if you are able to manage to have these transactions to take place off the blockchain, but still in a secure and safe way, such that any sort of transaction that has already been committed to cannot be reversed because of some cryptographic primitive can help to govern that process, then essentially you're able to scale your transaction many times faster, because you can do as many transactions as you would like during the payment channel when it's off chain. And then when you and your counterparty think is pretty much finished in terms of the number of transactions you would like to have, you can then close your payment channel and then report back to the blockchain your net balance at the end of the transaction. So you only need to report what is your net balance towards the end of the transaction, put it back onto the blockchain, and the smart contract will reallocate the net amount to the respective party. And there is mechanism to solve for dispute resolution, to solve for timeout, all of that by leveraging what we call hash time lock contract. So again, just tapping into some of the very commonly found cryptographic primitives in blockchains, you're able to support and allow atomic exchanges of payments in CBDC to CBDC or CBDC to stablecoins through these payment channels. And we take it one step further to make it universal, in the sense to make it interoperable between potentially two different blockchain DLT systems. We will need to create these respective payment channels that are directly interacting with the blockchain to achieve the mechanism I just described. So hopefully, that's in a nutshell of what the universal payment channel is trying to facilitate. It's trying to create this central hub that sits in between the different blockchain DLT payment systems, And so it can then transfer token from one to another. It's almost as a sort of a universal adapter to translate one type of token over to another by converting them technology-wise, and then be able to handle the foreign exchanges and stuff that we have always been doing. But on top of that, this technology layer to really convert different forms factors of money. So this is still very much applied research. And I think there's a lot of angles that we need to look into, especially I said earlier, there's a really important component around compliance, and interoperability for cross-border compliance and standards is so important. And there's a lot of kind of work in progress. I see that by many sort of international players as well. And we are in those kind of conversation and development to contribute our ideas in terms of how do you not only allow these interoperability to take place, but also to safely monitor and ensure that these transactions are, within the standards and laws that are put into place by different jurisdictions. And then I think this is the last slide, and I would just end with some resources. We do actually have a website and publishing very recently around, how are we thinking about making digital currencies interoperable through this universal payment channel. So if you would like to hear more about how we're explaining, the future use cases, what might be driving these developments, as well as the potential directions that we're looking at, I would encourage you to take a look at our website, and I will be very happy to respond to any questions later today. Thank you. Leyla.
Thank you so much, Catherine. Very informative. Following the key points that you mentioned, actually widely adopted stablecoin with the potential reach and use across multiple jurisdictions could become systematically important in and across one or many jurisdictions, including as a means of making payments. I would like to invite our second speaker, Alex McDougall, who is going to speak on the formation of new type of digital deposit receipt stablecoin that is built by tech providers but issued by a bank, and on the limitations inherent currently that are preventing stablecoins from fully making the leap into traditional fiat industries like FX. Floor is yours, Alex.
Fantastic. Thanks so much, Leyla. Appreciate it. Thanks to all the organizing team. Fantastic conference so far. Thanks, Catherine, for a really informative deep dive into the interoperability around CBDCs, which is a super fascinating topic that's going to be dominating all of our discussions for the next several years. So my name's Alex McDougall. I'm the president and COO of Canada Stablecorp, a Canadian financial technology company operating around creating bank grade digital asset technology in the blockchain space. So we've really taken the approach, and myself, I come from an investment banking and a venture background, around, we spend a lot of time in the blockchain world 15 years out. What's this crazy cryptopia that we could all create where we're all on chain all the time, everybody's paid in native coins, deploying in native coins. We have these fully circular economies, it's all decentral. We have ID tokens, we have data supply chains, all of that stuff. But really where Stablecorp has taken the approach, and really where I think a lot of this panel and a lot of our discussion today is going to be, is around, okay, that's all fantastic, and we've spent a lot of time there since 2008, and particularly in sort of the 15, 16, 17 era. What do we do today? How do we start from today to make that first step forward and that first step towards growing from where we are? And we've really seen a lot, and we'll get into in this discussion, a lot of MVPs, a lot of proofs of concept, and a lot of things that have really proved out the point that there's immense value in some of these crypto primitives, and including what Catherine was talking about. But there's limitations on them, and there's limitations on how we've created sort of V1s and the MVPs of these, and they're always what's sort of stopping crypto from eating the world. And whether it's costs, which we'll talk a little bit about that, whether it's regulatory structure, whether it's the integrations, whether it's ugly and it's annoying to use. All of these things are kind of pieces that we've taken steps at trying to solve through various blockchain infrastructures, various private chains, various layer 2 scaling solutions, various ecosystems, various regulatory models, but we don't really have sort of this comprehensive framework to do it yet. And that's going to be, and this is one of the greatest parts about the collaborative nature and the collaborative efforts of the blockchain space, it's not going to be one monolith that solves it. I always think about the blockchain space similar to how you would create, a space venture capital fund. It's going to be a whole wide array of people operating at every layer of the technology stack and every part of the vertical piece that's really going to contribute pieces to solving this kind of step function value proposition that really needs to happen so that we can get the grandmas of the world operating on this type of technology in a way that is clearly and objectively superior to what we can do through the traditional finance world. And that's really where we need to get to in this space. Otherwise, this is just a cool technology that happens to have some interesting use cases. And we've seen those, those primitives and those V1s and those MVPs really explode in size and in value. And that's a really strong use case. But now we're really running into some of these scalability and next step issues. And so what I want to talk about today, and I have Stablecoin 2.0 as the title of this talk, the past being prologue. What have we learned from the first really 3 years, the first 5 years of crypto at some level of scale? What have we learned from the past year? What's the regulatory environment that we care about today and on a country by country basis? Catherine talked about interoperability between countries and interoperability between currencies. That's something that we're only starting to discuss because basically stablecoins today are US dollar only. And so as we create better partnerships, as we create better interoperability, we create better technology, we create better compliance frameworks across borders, we need to start managing those standards of how do we build FX right into the back end of our on-chain solutions. Because ultimately, every time we break chain, every time we need to go back into fiat world, or every time we need to sort of opt out, we artificially limit the machine speed loop of commerce that we're all trying to create here. There's the entire point of us building out this integrated blockchain solution globally is so that we can continue to have these ultimate data supply chains, these ultimate flows, this ultimate transparency, and this ultimate connectivity. And every time we need to break that to go and solve some solution that we can't solve technologically, we artificially limit this this web of commerce that we're created. So the three key questions that we're going to try and look at today is what regulatory environments is really where we're looking at, what technology is required for where we're trying to get to, and then ultimately what integrations are required. How do we make this easy and fun and simple and straightforward to use? So let's dive in. So stablecoins have really gone through a couple of evolutions so far, and they've evolved way faster than the majority of other technologies. And blockchain as a whole can say that because it's open source, it's always under attack, it's always under fire, it's always evolving. However, as a byproduct of the decentralized nature of a lot of blockchains, it can be challenging to evolve. And there's always this sort of fight between centralization, where I can make a change instantly and push it out to an entire network, which is how we've built our system of technology for years and years and years, and decentralization, where we have a wide variety of consensus mechanisms, and we need to get a broad view for how we evolve these types of technologies. Now, stablecoins are interesting in that they're a little bit different and have obviously tackled kind of two sides of that equation simultaneously. So the stablecoin MVP, and really we're looking at DAI, USDT, and some of the early initial stablecoins that provided that original use case of, hey, I need stability. I need this to not move around so I can flip between exchanges, so I can jump between platforms, so I can have a unit of account that moves me through this crypto ecosystem, period. Original stablecoins, maybe there was some rhetoric and some discussion about being used for payment and cross-border and some of these sort of traditional typical fiat use cases, but the original stablecoin MVPs were really used to improve crypto trading and improve access to decentralized platforms. And for that reason, they don't really have some of the economic fundamentals that really make some of the later stablecoins and what we're going to be talking about today more palatable, more broadly, more palatable from a broader regulatory perspective. And that's okay in a technological evolution sense. They were created to fill a need that happened at the time, and there's sort of two ends of the spectrum: the asset-backed version of USDT, and then the algorithmic version, more on the DAI side. And so they worked. They really went through a lot of fire. We saw some DAI pegging issues with some of the volatility. We've seen USDT and transparency challenges around what type of assets are actually backing those. But still, fundamentally, those are two of the biggest stablecoins that have existed today. And ultimately, though, they're on Ethereum only. And this is something that we'll talk about a little bit more as we go through this deck and presentation. Is there isn't really interoperability in the MVP version of these stablecoins. There's starting to be more across multiple chains, but the mechanisms of jumping between chains still very heavy, still very challenged, still very technology driven instead of use case driven. Now, really, when stablecoins started to evolve into this V1 version was after the DAI peg and after a lot more effort, thought, resiliency went into the algorithmic stablecoin piece, and also when a light really started to get shone on what are the reserves that are backing these fiat-backed or asset-backed stablecoins. And it was a very good thing. It used to be post a PDF of a bank statement, and there you go. Thank you very much. We're one-to-one backed. Then there started to be APIs directly into bank accounts to justify and back them, and then other sorts of forms of proof, and ultimately more auditing, more transparency, more economic looks from people like the Bank of International Settlements around how is this tether or this peg constructed, what is actually backing it. And more looks from the securities regulators around, okay, well, if you're not backing it strictly with fiat and you're backing it with other assets and other types of securities, then what does that do from a securities law nature? And so the stablecoin model evolved into something that's more transparent, more secure, more grown up, more regulatorily advanced, more robust, more resilient. And really, we saw that kind of grow, and we saw the overall stablecoin value proposition grow as well. As we start to get more and more institutions into the crypto trading and DeFi ecosystem, we've started to see a migration from USDT to some of the more transparent stablecoins like USDC, GUSD to a certain extent, Paxos, and some of those other more evolved stablecoins, UST as well on the algorithmic side. But today we're still sitting in this majority crypto trading world for stablecoins, and we really haven't broken into this cross-border trading. We haven't broken into this FX piece. We haven't broken into this remittances piece, and some of that is due to the regulatory nature. And so what Leyla was mentioning off the top is we at Stablecorp, we've kind of created a bit of a new model of stablecoins, which is called a digital deposit receipt. So we're working with a Canadian Schedule I bank called VersaBank in order to actually issue a stablecoin in name only that is actually an evidence of a deposit within a federally regulated Schedule I bank. So it looks at putting the regulatory piece where the regulatory piece should be, which is with the bank as an actual issuer of assets, as an investment grade bank, but puts the technology and the interoperability and the free-flowing nature of the asset with the technology companies like Stablecorp, who are the builder of integrations, the promoter, the distributor, all of that side of the asset. So it's really sort of an exercise in hybridization of where the regulatory nature sits and where the actual technology and the integration piece lies. So really where we look at stablecoin v2.0 is getting past the securities law pieces, getting past the transparency pieces, putting the regulatory burden with the regulatory side, and then allowing the technology companies to build out these complete comprehensive webs of commerce for creating this next leap forward for the stablecoin side. And I'll talk a little bit about what that next leap looks like, and again, where some of the artificial limiters are today. Because we've seen huge growth, and that's one of the biggest stories in crypto is this growth in stablecoins over the last year. It's up to 150 billion or so, and that's sort of the MVP plus the V1 stablecoins. But we're limited by ETH transaction costs. It's kind of a running low behind the scenes joke that everything that's built on ETH is a proof of concept, because there isn't scalability, and $20 gas costs will destroy any sort of value proposition at lower scales. And that's where everybody's working on it. The Consensys folks obviously are working on it extremely hard. There's a lot of good technology going into what is ETH2, what is the next scale, or what is the next version of this. But we're still building proofs of concept using that network and that technology. Stablecoins are USD only, which is Circle, a great example, signed a massive partnership with Bitso to go cross border, but it's all around US dollar stablecoins and US dollar connectivity through Mexico, not sort of an MXP based stablecoin. When we're working and looking cross border and looking to kind of create these global webs of commerce, we need to have interoperability between stablecoins of multiple currencies rather than just USD only. Securities law questions I covered of what the asset backing is and what attributes to that gets applied to the actual coin itself. FX tooling, we need to not have our FX solely live within traditional FX platforms. Right now, if there's any FX for on-chain stuff, it's as a byproduct of, oh, there happens to be two stable coins that are trading on a platform or on a DEX. We need to have that API base that fits right into the back end of cross-border webs of commerce. So when we have on-chain payment solutions, we have on-chain FX built right into that as an actual module. Those type of toolings don't really exist right now. It's still expensive to go on and off and expensive both in terms of cost and time and effort. And we don't really have integrated fiat on and off ramps into a lot of these more traditional webs of commerce. The business model and the BIS status, the Bank of International Settlements has taken a defined view of what forms a type of stable asset that can be held by a bank and integrated into our traditional financial system, and that's a pretty tight standard still. So there's a lot of multiple chains that are trying to solve this. Algorand, one that we'll talk about more in a little bit. Stellar has reduced costs a lot. Solana has obviously had a pretty aggressive year in growth on the stablecoin side. UST has done some really interesting things and seen a ton of growth as well. And Polkadot, which you're going to hear a lot more about in the short term as well, and sort of builds in interoperability by demand. But really, we need to get to a place where this is a use case pull type of interoperability. I want to do this with my coin, and the chain happens in the background. Right now, it's very much technology first, technology focused. And we can't expect the people who are going to be using these types of technology at scale to be like, yes, I would like a Stellar USDC, or I would like an Algorand VCAT, or I would like a Solana one. That's just, it's not where sort of the end result needs to lie. And so abstracting that interoperability and moving it below the surface and taking it into the back end is really a key part of this, creating this integration in this web of commerce more broadly. And then alternate currencies. We're obviously focused on the Canadian dollar, peso, GBP, the pound or the euros and yen as well. And there's nascent stable coins in all of these, but they're all very siloed and very isolated and not really connected to this global fabric. And part of that's tech, part of that is this traditional business model, part of it is what Catherine flagged as inter-country commerce as well, or inter-country compliance as well, rather. So I want to talk a little bit more about Algorand ecosystem and just sort of paint one journey that would be a very smooth and slick user experience through the platform. So a couple of these logos are Stablecorp products. Again, we've created some of the tooling layer, some of the actual asset layer. So a seamless on-ramping. So direct connectivity, sort of a plaid for crypto style, if people are familiar with that API concept, where you can go straight from your fiat bank account through a module that sits behind the scenes and then settle directly into third-party applications, whether those are centralized or decentralized. And a key part of that is KYC harmonization as well. So we've obviously tried, there's been a lot of identity protocols that have taken stabs at this, and compliance is a huge part of this. So there's V1s of these sort of KYC interoperability as well that are more brute force, that are more data sharing, that are more contractual based, but still get to that same seamless customer experience at the end. And so a lot of this interoperability is really about not as much about the technology, but about having compliance systems and structures talk to each other, having reporting obligations to FinTrack or FinCEN be able to be pulled out of these interoperable solutions. So having a seamless on-ramp, being able to get multiple chains and being able to swap between multiple chains of a specific asset seamlessly and ideally, as I mentioned before, behind the scenes. So when you're having that direct connectivity between your bank account and a third-party app, have that what third-party app you are connecting to be what drives what chain your coin is minted on. So being able to not have to choose what chain, but have that be a byproduct is a really, really interesting piece of interoperability. And then have curated recommendations and curated structures for where you're going to earn yield, where you're going to do your FX, where you're going to deploy your cross-border payments, and have those all be able to be seamlessly connected, one-click deploy, have the wallets connected all the way through in a decentralized world from that bank account on the front end, or have the portals onboarded into centralized platforms on the back end of the bank of the ecosystem as well. So really to get to this kind of next stage of where we want to get past this 150 billion into the trillions and into really taking that bite out of the traditional fiat market, which is ultimately where the stablecoin world is going, where the stablecoin world is aiming to get to. We really need to start with the fiat world today, those initial borders and those initial barriers, and build out this web of connectivity all the way into the end use case. Have interoperability be native and out of the box, behind the scenes, abstracted away. Have the correct regulatory pieces, so where the asset construction, the end users and end integrators of that asset don't have a worry that this is going to be named a security tomorrow. Have the regulatory transparency and the BIS structure such that assets can sit on traditional regulated finances balance sheets in a way that makes economic sense. And so all of these need to come together. And this takes me all the way back to my first point of this isn't going to be solved by one company, one person, one technology, one group. It's going to be solved by a comprehensive web of interlinked, interoperable solutions. So there's a whole bunch of these things that we need to tackle, and really excited to share the floor with the panel today to start diving into some of this stuff. So that's it for me. Thanks very much, guys. Really appreciate it.
Thank you so much, Alex. It was very insightful. Okay, so, and actually following it, if stable coins would be standardized, it would help for their interoperability. Unfortunately, the standardization of stable coins is still in its infancy. I would like to move to our next speaker, Guangbo Zhang, who is going to share with us on implementing interoperability with Polkadot. Please, Guangbo.
Oh, thank you, Leah. Just a second, please. Sorry. Okay, thank you, Leah. Good morning and good afternoon. This is Norman Zhang from Web3 Capital. Well, in the Catherine and Alex space, they made a very clear explanation on the importance and also the obstacles faced by the stablecoin right now. So I would just skip that part and start with existing approaches to address interoperability in crypto world. Then I will introduce a new paradigm for it, and which is a Polkadot. Which is a Polkadot, and last but not least, I will introduce a DeFi hub in the Polkadot ecosystem, Akala projects. So the goal of the interoperability or cross-chain at the very beginning was to allow assets to be transferred from one chain to another and back again safely. So the later expands to solve the problems of mutual transfer and exchange assets and the states on two or more different chains. Cross-chain technology is considered to be the holy grail of the development in the blockchain fields, and the key technology to realize the interoperability of all chains. So let's start with an overview of existing approaches for transacting assets so as to understand where we are right now. According to evolution and implementation of the cross-chain technology, one summarized, Vitalik has summarized 4 categories of cross-chain technology, which are hash time log contract, notary, and a sidechain relay chain. And this is a part and this section can be divided in 2 parts. So the hash time log contract is a set of the cryptographic mask to enable cross-chain trustless asset transactions, such as transaction between ACE, BTC, or Base Ethereum to complete transactions through a hash lock. The notary scheme means that the notary established an intermediate account, the users transfer assets to the media account, and notary issue shadow tokens to the users across the chain that maps original tokens. When the users needs to redeem, the shadow token is destroyed and proof is provided to the notary. And notary will transfer the original token in the intermediary account to the user's address. The third one is the sidechain, the relay scheme, relay chain scheme. The general solution is similar to the notary solutions. It still has an intermediate account, but intermediate account is secured not by notary, but by a small contract that regulates it. This means that the intermediate account will be a contract account whose asset management roles are governed by the code of the smart contract rather than by the notary. If there's nothing wrong with the code itself, the asset in the contract are secure as long as the chain deploying that contract is secure. The reason why I say this as three mass before is that we come to the point that there's a new solution. There's a need for a new solution to solve the problems we may face today. The general solution for relay chain or side chain seems perfect enough, to be honest, but we have a higher pursuit for cross chain. One is that a multi-chain reuse asset bridge can be compatible with as many existing chains as possible, but new chains keeps emerging. It is too troublesome to expand the compatible again. Can there be a universal chain or framework for new chains to follow the framework and be able to achieve cross-chain once and for all? Yeah, that's one first question. And second is that our pursuit of cross-chain is not just to achieve asset bridge. We also want to pass richer information between chains and have a strong interoperability, such as ability to core contracts across chains, so that multiple chains can really connect. So based on the pursuit of these two goals, there are heterogeneous multi-chain projects like Polkadot in the blockchain world. It adopts the architecture of one parachain with some subchains, where the parachain is a public bridge chain for all subchains. And any developers can develop subchains according to the pre-described framework and apply for the access for the parent chain. Okay, so let's move on to the Polkadot. In order to fulfill the dreams, the ex-CTO of the Ethereum, Dr. Gavin Wood, left Ethereum and founded Polkadot. Polkadot is a scalable, heterogeneous multi-chain blockchain. This means that it consists of a collaborative, decentralized blockchain network called the relay chain that interacts with shared chains running in parallel, known as parachain. This is a parachain can be considered as the clients of the relay chain, whose pursuit is to secure and coordinate them. And the Polkadot enables parachain to communities through a messaging protocol called cross-chain messaging protocol, XCMP for short. This is a part of this framework on the right of the diagram. Therefore, this parachain not only are interconnected, but actually contribute and connect to the shared security pool for the entire ecosystem. And Polkadot also provides framework to build a new blockchain called a substrate. Substrate seamlessly connects all the parts of the new chain, making existing blockchain easily scalable by reusing existing features of a different parachain. So Polkadot accomplishes interoperability through two primary means. First one is interoperability. The relay chain offers internal operability between parachains is feasible because all the parachain and the parathread communicate in the same language. And also as for the external interoperability, they will be accomplished through the use of customized parachain known as bridge. The bridge connects two separate blockchains. As for the internal operabilities, blockchain allows parachain to send not only tokens, but also other type of any type of the data between each other, opening up a host of the new blockchain use cases. Blockchain developers can build services that take advantage of the features of multiple blockchain, and rather than being limited to the features of any one chain. So, the consequence of having chains to be heterogeneous is it means that they can specialize in some of unique features that they provide to the rest of the ecosystem. For instance, we might have the parachain that are specialized in DeFi services, privacy, or digital ID, or maybe NFT marketplace. There might be chains that optimize for generalized smart contracts execution, so they are very similar to the Ethereum. But we may also have WebAssembly parachain that allows one to write smart contract in WebAssembly. For instance, parity Inc language. This is part of what we elaborate in the next slides. And there might be chain that optimize for privacy, so they provide privacy features for the entire ecosystem whenever someone in this ecosystem need them. Yeah. So when we dive into the interoperability of the Polkadot from a programming perspective, we see two fundamental technology: the EVM compatibility and WASMA. In the past 3 years, we have witnessed the outbreak of the public chain ties. The reason for the excitement of this public chain is that in addition to the hyper of the markets, almost all of them are compatible with the EVM, this Ethereum virtual machine. The rapid use of smart contract and in fact capability enables the ecosystem to expand rapidly. Therefore, this is kind of a must for public chain to integrate with the EVM. Polkadot has integrated with it, and Polkadot does it more. Although EVM is currently a relative complete mechanism in the blockchain field, but its limitation also appears to be outdated, considering all the development of the blockchain. And WASMA contracts and upgraded version of the EVM contracts have begun to attract lots of people's attentions. The full name of the WASMA is a WebAssembly, and this is a binary instruction format that runs on stack-based virtual machine. This code can be C or C++ or Rust, etc. WASMA was originally a virtual machine designed for browsers, but after more and more developers use WASMA, they gradually expand the usage scenarios of WASMA and making WASMA one of the most common format at present. The advantage of WASMA compared with EVM is fast execution speed, low transaction costs, and a wide selection of contract language. In 2020, Parity have developed a substrate modules compatible with the Ethereum EVM and a compatible layer frontier, allowing EVM smart contract to interact with other substrate modules. Users can also deploy Solidity smart contracts directly on substrate, and use Web3 RPC tools such as MetaMask to interact with on-chain applications. Therefore, the substrate-based chain on Polkadot can have two modules at the same time. One is an EVM contracts module used to execute the original Solidity EVM code, and the other is a substrate contracts modules used to execute the Solidity WASMA or Inc WASMA codes. The two are interoperable, and the messaging can even be published on the separate Parity Ethereum chain that is bridge over. If deployed as a parachain, they can be spread to the wider Polkadot community, including the Ethereum mainnet. Secondly, as for the external interoperability, bridge in the Polkadot system serve as a bridge to connect Polkadot with external blockchain. Blockchain bridge are ways for two economic, sovereign, and technical diverse chains to communicate with each other. Bridge design comes in a variety of flavors, ranging from central and trust to more decentral and trustless. Polkadot favors later bridge design for its ecosystem. However, there's nothing that blocks the development team from building and deploying the former the Polkadot design enables some of those parachain to act as bridge to existing independent blockchain, and this bridge to bridge them to the ecosystem. So yeah, certainly to make it easy to build Oracle system, Substrate comes with built-in features that allow developers to write and build and run oracles directly as part of the parachain and or standalone blockchain. I try to make it short. For instance, the thing that Chainlink does for Ethereum is something that can be built within Substrate-based blockchain currently. As far as I know, Chainlink is actually using off-chain workers for their Polkadot integrations. Well, the last slide is about Akala. Akala is a DeFi hub of the Polkadot. This is a layer 1 smart contract platform that is scalable, Ethereum compatible, and optimized for DeFi. The Akala dollar AUSD that is right here, you can see the Polkadot is the built-in programmable primitive of the Akala network. AUSD is the Akala native decentralized stablecoin backed by dots and a dot derivative and a cross-chain asset like Bitcoin. So at the bottom layer, in layer 1, you can see the Polkadot is a ledger as well as a trust you can see that the Polkadot is a ledger, and Akala is using Polkadot as a service for providing the trust, because Polkadot basically keeping the track of everything, and at the same time it provides a validator set, which is the shared security pool that probably you have heard. Akala platform also have the ability to interact with external blockchain like Ethereum and Bitcoin and others. And also this is a kind of interoperability is powered by the Polkadot. Then allows their this is kind of a technology allows a parachain to seamlessly communicate both internal and external blockchain. This features also allows Akala to realize their missions of building a true interoperable stablecoin. So yeah, meanwhile, Akala is also connected to the compound gateway that you can see on the left corner. All this is going to be brought on a Akala network and can be acted as a collateral to mint AUSD. Meanwhile, anyone can use this kind of facility that Akala provides to create another layer of applications, protocols, lending or borrowing, or any type of financial instruments. Most of the operation actually powered by this by Akala DeFi infrastructures. Okay, that's for my the presentation. Thank you so much.
Thank you so much, Guangbo. It was very interesting. I would like to invite now our following speaker, Daniel Lynch, who is going to share with us on Consensys approach to interoperability. Please, Daniel.
Hello, everybody. It's a pleasure to be here today with all of the attendees and also such talented and experienced panelists. I think I will be covering some similar topics and hopefully expanding upon some of the great coverage that we've seen from them. Pull up my presentation in just a moment. Wonderful. Just one second. Great. So I'm here from Consensys. You may know us as a thorough blockchain development company working from everything from protocols to applications with both decentralized protocols as well as large institutions. I've been working recently on developing a strategy for working with FIs and fintechs, and that certainly involves thinking about interoperability amongst stablecoins and CBDCs. So first, much as some of the other speakers have noted, I like to think about interoperability across 3 dimensions. One is certainly the ability to build bridges across different networks, which is incredibly important, and I'll cover that. But I also, as some of the other speakers mentioned, like Alex, like to think about 2 other interoperability concepts that I think are sometimes neglected at the expense of this very important question of bridges across chains, which are having interoperable regulatory frameworks, as well as integration with existing methods of modeling transactions. So just to speak about bridges, which is generally what we talk about when we're talking about interoperability interoperability. We've been working here at Consensys for a long time on building public sidechain bridges that allow Ethereum users to easily move assets between the mainnet and sidechains. That includes automated bridge fees, transaction tracking, and more. But I think very important here in a lot of our work has been thinking about how to create private network bridges that can move between different consortia chains. And I think this is super essential to think about, because a lot of the times that we talk about interoperability with CBDCs and stablecoins, we're talking about the ability to swap them for each other. But if we think about the US dollar or the yuan or the euro as, an older form of technology, they in fact integrate with a number of systems, not just swapping against each other, but other economic systems that are likely going to move to the blockchain. So just a brief example, when you think about retail, right? When you go to buy a suit or a dress or some perfume or anything in the apparel space, there is a relationship between a retailer and a vendor where the vendor emits a catalog and then the retailer sends them a purchase order. The vendor then sends an invoice and a shipping notice, and maybe the retailer sends some type of reception advice for that invoice and shipping notice, and then also perhaps a reception advice for the actual goods. If you think about this chain, which is referred to as like procure to pay or like sales and distribution. Sales and distribution is a module within ERPs if you're deep in this space. There's actually no transfer of value there, but there is a lot of talk about moving this to the blockchain because there is intense reconciliation amongst many parties and dealing with provenance and things that could be much more efficiently handled with handling this in a blockchain or distributed ledger environment. There are many more examples like this. You've seen JP Morgan, I think, is working on within their Link software. There's a product called Resolve that does like case resolution for payments. So payment can be paused between banks because there is an incorrect interbank settlement date, or because you need the date of birth of a debtor to do further investigations. There could be security settlement and reconciliation blockchains. Here at Consensys, we have launched, in consortia with a number of logistics providers, a network called Covantis for supply chain. We've also worked in commodity trade finance in a network called Comgo with a number of banks. We can think of KYC applications, standing settlement instructions within the FX, securities, or derivatives markets. All of these are likely to have consortia on blockchains, particularly given the business units that exist with banks on separate chains. And in addition to being able to swap the value of a stablecoin or a CBDC for another, we also want to have systems that can efficiently transmit this information across chains. So to that end, we're doing a lot of work in software development, but also we like to contribute academically and to open source standards in this. So we have a thing called the General Purpose Atomic Cross-Chain Transaction Protocol. I am not going to get too deep in this here because I don't think 14 minutes is enough to do it justice. And also, I don't think I'm the person who can do this best. We have a wonderful researcher by the name of Peter Robbins, and you should check out. I've included the links here in the presentation to learn more about GPAC. This is our GitHub repository. There's a 20-minute webinar. There's a 1.5-hour webinar that if you have the time, I highly recommend, because it's really great for everyone from lay people to business people to technical users, as well as our academic paper. It's about 11 pages. I think you can probably get through it pretty quickly, but basically the idea of this general purpose atomic bridge is that we want it to be generalizable, where you can execute arbitrary code and return values across two or more chains, pluggable to existing standards, support atomic transactions, and also very easy to use. And at the core of this is ensuring that there can be cross-chain applications, function calls, and messaging that can interact both in the swaps of value for one coin or token for another, but also this information that can be so important in linking supply chain systems with trade finance systems, with transaction banking systems, for instance, right? Because ultimately, again, currencies as a form of technology are integratable to these systems, and we should be thinking about this across those different applications of cross-chain bridges. This is our roadmap. Just to make sure we have time for the Q&A, I will pass over this, but this is a approximate roadmap for us rolling this out this year. And feel free to reach out to us to learn more about how to participate. Now, I noted before, when we think about the regulatory framework, I've been thinking a lot about how emergent models like DeFi can affect this. So launching a CBDC now is not like launching or investigating a CBDC, I believe, in 2017 or even 2019, and that there has been an emerging parallel financial ecosystem that we've seen through DeFi. There are equivalents in decentralized exchanges, decentralized brokerages, decentralized lending applications. And I think core to developing a regulated or sovereign stablecoin or CBDC is figuring out how you can take advantage of this open source innovation and apply it. I think we've seen some interesting cases of this. There's the Lift Challenge being promoted by the Bacen, which is the Central Bank of Brazil, which hopes to really investigate how launching a CBDC could help them in standard PVP, DVP formations, but also how they could incorporate DeFi models. I could think about, for instance, how you could have a liquidity pool that is regulated, that is KYC'd, and also has maybe certain goals built into its design for more financial inclusion or helping SMEs or, the unbanked have savings and loan capabilities. And that is going to require a regulatory framework, certainly, for being able to use these stable coins in these contexts. The third, again, is interoperability with kind of legacy transaction modeling. I worked at Swift for six and a half years, many years in the payments innovation team, working with banks and central banks on payments innovation and standardization. And I will say that, just to rush through these ones a little, to give an example, if you talk to people about applications of CBDCs in the banking world, there's really two or three that people talk about a lot. One is DVP and securities. Let's ignore that one for a moment, just so I can make this example. The other two are really intra-institution settlement and liquidity management. So across three of my business units, I want to be able, as an end of day or intraday liquidity optimization, to be able to move value across these different units very easily. And then, of course, the Holy Grail takes that out of intra-institution to inter-institution liquidity management. If you know how like a cross-border wire works, an ordering bank in the US or a person that wants to send, or a business that wants to send money to Colombia, there's not actually value moving across the chain. Now, this is a little bit how it would look like in a blockchain, but you see this ordering bank here. Today, what they do is they send a message asking their correspondent to debit their account, which they already have, for further credit to the beneficiary. So today, a US bank will send a message to their correspondent in the US saying, please debit my account for $1,000 for further credit to this beneficiary in Colombia. Now, the correspondent bank then goes to the next correspondent bank and says, can you debit my account for further credit to this account in Colombia? Reaches the beneficiary bank in Colombia, and the creditor or the beneficiary's account is credited. There are billions, maybe trillions of dollars locked up in these Nostro accounts where, the promise of CBDCs and stablecoins has largely been that we can instruct payments to each other and maintain a lot of the banking infrastructure without having to have this money locked up in each other's accounts, which is a practice that really stretches back to, honestly, the Middle Ages. There's a lot of technology and messaging behind it, but the idea of this funded Nostro account is something that, many folks have talked about moving away from. Well, one thing I'd like to note is, if any of you recognize this is the famous PAX.008 FIT, Financial Institution Transfer, Customer Credit Transfer message. And what this is a message that, hundreds of banks, standards organizations like ISO and SWIFT, and dozens of central banks have worked together to create what they think is the perfect representation of a payment. And now a customer credit transfer being one of those payments with a ordering party and a beneficiary. And, I think a lot of us think of blockchain and DLT as a panacea that's going to eliminate a lot of this financial messaging. And that's certainly true in many cases. The most used message on the SWIFT network today, I believe, is the 548, which is a status message between a custodian and a central securities depository when the settlement and reconciliation of securities is not going well. Well, when everyone's working from the same ledger, ideally, we can get away from that, right? Similarly, many status and confirm messages are like this. But this message, this format of this message, currently there's about probably 36,000 financial institutions globally, 200 something market infrastructures working to implement this richer ISO 20022 standard for implementing a credit transfer. A lot of reasons for this. It has structured beneficiary and ordering information so that, you don't break the travel rule. You can reduce false positives in payments. when Mark Cuban receives a payment today, he is almost certainly on a whitelist so that the sanctions screening doesn't catch him with the OFAC sanctions against Cuba. With this, like Cuban as a last name segment is separated such that you don't have to do these like whitelists anymore to reduce false positives. It has richer remittance information, whereas before there were smaller references. You could fit an entire invoice into this if needed. And I think it's very important that we think about the messages that are essential and the systems, the market infrastructures, the back-end offices, systems that produce these and consume these. How can we tie these to movements of value on ledger? So, we've been doing a bit of work to this end. Conceptually, here's just a little bit of like maybe how Consensys has been doing it, not just for CBDCs and stablecoins, but we have a series, with middleware with a series of API calls that we are helping institutions to implement on their back end to have wallet management that is exposed through their front end portals, applications, and APIs, but also integrates very importantly with treasury management systems, core banking, order management systems, et cetera. I think it's really a pleasure to be on the same panel as Catherine because I think Visa has really been a pioneer in this and that they've been doing great efforts within the CBDC and stablecoin space while also finding ways to expose this innovation to banks over existing API channels that they can regularly consume. So always a pleasure to be working with folks thinking along the same line. And then again, in summary, I think there's really those three core components to interoperability, which is at a technical level, the bridges, but also think of bridges not just as swaps of value, but many interconnected chains, perhaps consortia chains for information sharing. Secondly, this regulatory framework, particularly in thinking about the environment we live in today, which is not just CBDCs for better settlement, reconciliation, but also integration with some of these new emergent models of DeFi. And then, of course, thirdly, integrating them with a lot of these great efforts for transaction modeling that we see happening, particularly with the global migration to ISO 20022. With that, I thank you all, and it's just a pleasure to be with you, and hope we have a great Q&A. Thanks, Leyla.
Thank you so much, Daniel. It was so informative. I would like now to invite all the panelists. We are moving now to the panelist discussion and Q&A session with audience. And I would like to invite the panelists to turn on the videos and join the panel session. Great, thank you. And there are a few questions that I would like to ask our speakers. I would like to start with you, Catherine. So what are the key challenges of CBDC and how is Visa contributing to the dialogue at this point?
Thank you, Leyla, for that question. I think there's many different challenges that central banks are facing because each one, I think, as they're exploring this whole journey around CBDC, they have very unique set of motivations. Most of those are tied into the policy objectives that the country is aiming to solve. So some of the challenges, for example, could be around financial inclusion that applies to both, countries like the US as well as developing countries. There's many people who are unbanked or underbanked. How do you, as things become more digitized, how could you bring them on board and allow them to enjoy the benefits that the rest of the world is? So it's key kind of around financial inclusion, but also I think, since we're in this conference around stablecoins, there's certainly this trying to find the right balance between what does it mean in terms of stablecoins, the private issuance of money in relation to the monetary sovereignty that many central banks are very important as part of the key pillar. And how do you really run an economy trying to, monitor for growth, for employment and all of that, while there's now more and more different flavors of money available for people to use and spend. So a lot of those I think countries, monetary authorities are taking a keen interest in understanding both the technology, but also the policy planning going forward for both stable coins as well as for CBDC. So I think that, the key is that it's very different and unique for each country. But we do think, at least thinking about CBDC from a product angle, some of the key challenges that central banks commonly find is that if you're looking at CBDC as this new technology going to be used by people down the road, well, there's this obvious challenge around adoption. Would people use the CBDC when they come out? In fact, we're still trying to figure out all the use cases for stablecoins and whether that's widespread or not. And coming to CBDC is going to be the same thing. And then when you're looking at business and merchants, this is where you're looking at what about the coexistence of the existing infrastructure. Surely you don't want to just waste away all these valuable assets and move on to something else. So what does that coexistence and integration point look like as you're trying to push for a new generation of payment technologies? But how do you bring the rest of the ecosystem onto that system? So, in engineering term, we think about it as backward compatibility. And that's a key area that is really important. And Visa is really contributing into the conversation from both the user perspective, but also merchant business, trying to think about how we can play that role in connecting with them.
Interesting. Thank you so much, Catherine. Following with the challenges, Alex, and what were the main challenges to implement your solution at Stablecorp?
Yeah, for sure. And it's a really interesting question, and sort of harkens back a little bit to my presentation, is that it's very multifaceted when you're creating new assets. And I think the asset transmissibility between different regulatory regimes, different technology stacks, but ultimately creating that harmonized consumer or harmonized end user experience. I think that's probably the biggest challenge that we're all facing right now is there isn't one way to solve this. There isn't one technology solution to solve it. And I think that's sort of the whole point of this panel overall. I mean, specifically for us is really getting regulators and getting sort of traditional financial institutions to look at the things they know, the frameworks and regimes that they've created, and then what exists in the digital asset space today. Because we've created a whole bunch of new names and a lot of new concepts and new things, but fundamentally there's a lot of similarities. And I think Daniel and Guangbo did a good job of talking through this as well. There's lending platforms, there are exchanges, there are these same archetypes that exist in the digital asset world as they're doing in the traditional world. And something like a deposit receipt, there's already equivalencies for that. There's already deposit receipts. We think about it in kind of the dumbest terms as like a digital traveler's check. There's already something that exists that is an archetype for some of these new things. It's just really drawing those equivalencies, making sure you have sort of your downsides trimmed, and make sure that you have an understanding all the way down to the ground securities law and banking law, and making sure you're tracking it all the way from the end asset that looks very new and novel down to the fundamental ground floor. And then when you're thinking about, okay, great, we understand that from a Canadian perspective. Well, what does that look like in an American perspective? What does that look like in a British perspective? So really nailing those. The tech interoperability is one part that we spent a lot of time on today, but it's really the compliance and the regulatory interoperability that's as important. And we built our regulatory frameworks with a certain amount of interoperability already. We're pretty bad at it in the grand scheme of things, but at the core, lowest common denominator, particularly within Canada and the US, there's certain levels of understanding and cross-border stuff. So how do we piggyback on that to create this sort of currency technology, or this currency and regulatory interoperability as well? So really, the tech for creating a new stablecoin asset, not that crazy. We've done it before. Everybody's done it before. It's really solving these other non or less technical pieces that's really the interesting part. Obviously, cross-chain interoperability has its own technical challenges, which we've talked about a bunch. But a lot of the stuff that we really grappled with was business model and reg side.
Thank you. Indeed, like I'd say there are a lot of fragmentation on both technical and legal standardization aspects, given the technology is borderless, and existing efforts to coordinate among jurisdictions have been piecemeal at best and chaotic at worst, let's say. Also, like on Consensys side, Daniel, could you speak a little bit more about the challenges and opportunities around using traditional transaction modeling or messages with CBDCs?
Unmute, apologies for that. No, I had mentioned before, I just think it's a tremendous challenge in that, we don't want to throw out the baby with the bathwater here, and that there is a lot of things that need to be innovated away, but there are a lot of things that have been explicitly designed to work quite well. And I mentioned the instances of the ISO 20022 migration in terms of the customer credit transfers, the payments happening, and the number of institutions and market infrastructures committed to this. And I think there's tremendous potential to create new methods of settlement, but a payment is not just settlement of cash. A payment is a whole set of information being exchanged between institutions. And to this end, I think it's incumbent upon all of us to really participate with these market infrastructures, to participate with all the bank and non-bank FI participants, but also to really map out all of the, having done some payments innovation initiatives with like broad scale 10,000 institutions at Swift before, to really map out all the different technology providers that will have to be involved as well. So there's, again, many core banking and payment application systems that will have to be able to choreograph this exchange of, I call it a message, but the ISO 20022 models, it's really a data structure. It could be APIs. It doesn't have to be a message, but that this rich standard of information can be exchanged between institutions, where you'll have to integrate with core banking applications, payment applications, order management systems. We think about case resolution systems. And then, of course, people don't pay each other for nothing, right? You're always paying for something. So whether it, again, I don't know if this will extend all the way out to corporates maybe being able to have wallets, or even people. That all depends on how legislation rolls out. But there's obviously like treasury management systems at the corporate side, ERPs. And then, of course, on the security side, there's delivery versus payment of security. So matching up those payment applications with order management and custody applications is a tremendous challenge in front of all of us. And I think we really need to zoom out. We need to be laser focused on ensuring that there is interoperability between these chains at a technical level, but then also interoperability amongst all these systems, be they national or intra-institution.
Thank you so much. I'm curious to ask Guangbo, Akala is the first DeFi solution on Polkadot. How is it interoperable with other blockchains, for example, Ethereum?
Thank you. In 2020, Paradigm have developed the substrate modules compatible with the Ethereum EVM, allowing the Ethereum EVM smart contracts to interact with other substrate modules. So I think this, from this technical perspective, that developers can deploy Solidity smart contracts directly on Substrate and use tools like MetaTask or Struffles to interact with on-chain applications. Actually, engineering team of the Akala has already built its own Ethereum virtual machine. And actually, the founder or the engineering team of any parachain in the Polkadot ecosystem can utilize some of the smart contract parachain platform like Moonbeam, or to integrate their smart contract platform ability. So but Ethereum developers could deploy their, so most of the Akala team didn't choose this way. So Ethereum developers could, in the Akala ecosystem, Ethereum developers could deploy their smart contract directly on the Akala network. So the Akala EVM is one module on the Akala network, so it offers all kinds of features. But I think those are probably the things that draw my attention, that bring your own gas, which means that once you can use native or cross-chain assets such as DOT or Akala tokens or AUSD, that a stable coin, there are RMBTC and more. ERC20 token deploy in the, as long as it's kind of as long as it's the kind of the ERC20 tokens that deploy in the EVM, that can be used as a gas fee for that. So it's very compatible with the Ethereum. So lastly, there's on-chain automatic scheduler that enables use cases like subscriptions and recurring payment, etc. So this is a kind of things that this is kind of the way that Akala used to interoperate with the Ethereum. Yeah. Thank you.
Very good, thank you. And what is the advantage then of using Polkadot to build an interoperable solution?
Okay, so I will still answer in the technical perspective. I think the first thing is about the development tools. In order to efficiently build mailing different blockchains, they have the Polkadot team has put all the functionality needs to build a blockchain in the framework. And this is what we call a substrate. And the idea was to make creating a blockchain more scalable and flexible as possible. And also I mentioned in the slides that XMP are embedded in the substrate framework and lay the foundation for the interoperability, since the those parachains are designed in the same language and framework. So another advantage is usage of the WASMA. I didn't elaborate more in my slides, but compared with EVM, which requires developer to pre-pile and has a huge higher programming cost, the structure completeness of the instruction or exact execution efficiency of the WASMA virtual machine are far better than those of the EVM virtual machine, and it will become, I think it will become new engine for the contract development, and also for the execution speed is quite fast. WASMA has a complete set of the compact binary format and small size. And this makes the efficiency of WASMA bytecode running close to that of the local machine code, which is 1 or 2 orders of magnitudes higher than the performance of EVM. And also, last but not least, is the contract language is wide. WASMA extend the language series available to the smart contract developers and support the use of the WASMA language such as Rust, C++, etc. to deploy and write complex business logic, which means that you can developer can write smart contracts in any language you are familiar with, including the probably the most mature ink based on Rust, etc. Yeah, thank you.
Thank you so much. Very insightful. I would like to come back to Catherine. Catherine, currently, like, what are the Visa's involvement in CBDC today and its focus?
Two fronts, I would say, broadly speaking. One is we continue to contribute to all these ongoing dialogues or research efforts by every single central banks. You know, we're doing our applied research as well. I mentioned around offline payments, as well as things around interoperability and stuff. And I think it's a really important area. You know, it's kind of almost looking at this as a public good that everyone should contribute. Looking forward to having, you know, developers getting active and, you know, things that we publish and share out there. We definitely welcome everyone's participants, and especially the people from the developer ecosystem, to sort of comment and let us know where the bugs are, and we can go and fix them. So that's kind of what we're doing. And the other stream is sort of focused on sort of early enough, like, I guess, product initiatives that we think might be helpful when it comes to the CBDC land. So I'm glad, you know, my colleague Daniel here is on the line from Consensys, because we have announced the partnership between Visa and Consensys as one of the first initiatives as we're going to the CBDC, thinking about, you know, I mentioned around the user adoption being one friction point. And then for merchants, there's the other friction point about integration into the existing ecosystem. So, you know, between Visa and Consensys, what we are working on is developing this integration point so that the Visa network can then be integrated into the Consensys quorum. And assuming, you know, CBDC network might be built on an Ethereum-based one, such as the quorum network, how could you then integrate an existing VisaNet infrastructure into that? And then what's going to happen at the front end is essentially, you know, we're trying to allow consumers to spend CBDC from day one. When CBDC is created from day one, we want to make sure the existing banking application can go and support it. But then on the same angle, you know, we don't want the merchants or business to go out and upgrade their point of sale terminal straight away, because it requires a lot of investment, it requires a lot of time and conviction that this is the technology they want to go to. So what we're trying to do is to, you know, handle all the complexities at the back end and convert CBDC back to the normal commercial bank money, and then you can flow on the full-party model, still following, you know, using your card experience the way you have always done, whether it's tap to pay, click to pay, scan, whatever you like, right? But the key is you're now, as a consumer, spending a new form of money. That money might be given to you, say, through government stimulus or such. But the key is you're spending a new form of money, while on the merchant side, they can accept it just as it is, because on the back end, you know, the Visa CBDC payments module, and that's what we call it, is helping to do the back end complexity and the conversion in order to prevent any upgrades. But we're also needing to solve some sort of, I guess, intricacies when it comes to technology sides. For example, there could be a double spend attack because Visa network is handling real-time, in milliseconds terms, real-time authorization. But transaction on the blockchain can still take, even if it's a few seconds, there is still a latency between that. So how do you address this potential double spend opportunity through linking it to our network? These are the things that we're trying to work through with our engineers together with our partner to help and solve.
Very good. Thank you. It's good to know that there is a partnership between Visa and Consensys. And following Daniel, you'd mentioned instances in enterprise or bridges across chains being amount much more than just swaps. Could explain that concept in further depth?
Yeah, so I mean, I'd mentioned this in the kind of multitude of projects that we see in blockchain. And also when you think of institutions and business lines, not always having necessarily the same alacrity to implement these solutions. There's not one grand blockchain plan to rule them all that emerged in 2017 that many institutions or even business lines within a bank would choose. So like, I guess just as an example, I think of a trade finance, and you could make many examples here, but in trade finance, you can think of the number of chains that have to communicate information. So again, abstracting away from just the idea of swapping a CBDC or a stablecoin for another, like within the bank, you probably have like maybe a trade finance blockchain that runs like the term sheet of, how the import export's going. There's also probably like maybe a financial transaction banking element that actually does the payment to the importer and the exporter. That's two, and I hope you can visualize this, right? So we have a trade finance blockchain, and now we have a transaction bank blockchain at the bank. Let's imagine, just make it more complicated, the importer and the exporter are using multi-signature wallets. Boom, we got a third blockchain here, right? Now, this term blockchain has to be communicating with a logistics blockchain, such as the one we have of Consensys that is tracking the movements of goods, and possibly depending on like what commodity it is, there could even be like a price oracle blockchain that is, checking the price of oranges or pig bellies. We know how commodities can be, right? So now suddenly you have a terms blockchain that is being run by the trade finance part of the bank, checking against this price oracle blockchain, perhaps the logistics blockchain, to ensure that everything is according to terms. When they do that, this information needs to be communicated. Oh, of course, I'll wait. All this information needs to be communicated to the trade finance blockchain that then executes the payment. I forgot the most important one, the sixth, which is the chain that the actual CBDC or stablecoin sits on. And really, there's only a payment instruction between like two or three of these, right? Which would be the wallets, the transaction bank, and the wallets, the transaction bank, and the multi-signature wallets that the importer and exporter are using. But there also needs to be a seamless flow of information between the terms blockchains, the price oracle blockchain, and the logistics blockchain. So it gets, and that's just an inevitability, right? When we look at the way that supply chain has evolved, maybe a little bit faster in some ways than other applications, we're going to have this seamless flow of information, not just swaps of assets, but communication across these. Thanks.
Thank you so much, Daniel. I would like to ask my last question to Alex. If you can tell us more, can you elaborate on how use of Algorand has facilitated the implementation?
Yeah, absolutely. And recognizing we're at time here, so I'll keep it short. But no, the Algorand blockchain has a bit of a unique consensus mechanism that does evolve some of the core, the scalability trilemma in certain scenarios of it. And ultimately, I mean, it's from a high level and simple perspective, it's dirt cheap to use. And that really, it adds a bunch of scalability out of the box, just not necessarily from a technology perspective, although, the transactions per second and all that on a comparabilities piece we can talk about. But just there's the ability to use it at small scale within the DeFi platforms on Algorand, within even silly things that are more unique to blockchain today of sending test transactions. You basically cannot send an economic test transaction on the Ethereum network currently. So we really look at it as a highly functional blockchain, particularly when we're working with our bank partners on the VersaBank side and trying to get some of the tooling and technology into the hands of people who aren't necessarily blockchain native. When we look at it from a pure front end perspective, how we can use it quickly, cheaply, effectively. But all that being said, the future of the world is multi-chain. There's not one chain that's going to rule them. So we're building across multiple chains. we really appreciate and like what the Algorand ecosystem has been doing. The new DeFi platforms that are in there are seamlessly integrated into our onboarding flow. And so we've had a lot of success and have really enjoyed working with the Algorand ecosystem on the funding side, the Inc. side, the foundation side, and really like the ecosystem and like the tech. So it's given us a way to create a low value transfer system, which is what a lot of people are looking to use on the stablecoin side, as much as the high value side is obviously what we're all trying to tackle as well.
Thank you so much, Alex. I really thank you very much for each of you to share your thoughts today and experience with participants and with everybody. In conclusion, I would like to summarize some key takeaways. Realm of stablecoins is quite diverse and still expanding, and there are major legal aspects that must be taken into account, which is not always the case for technologies. And furthermore, if the stablecoins are aimed at working on an international scale, then compliance becomes even more difficult given all the different legal approaches in the world. Technical interoperability is still also in its infancy because platforms for interoperable blockchains such as Cosmos and Polkadot are just being launched on mainnets in real settings. But on the other hand, stablecoins backed by fiat money have gained most of the attention to the regulators due to their impact on the financial market and the risks that retail investors or users if they were not fully backed or badly implemented. And it doesn't mean though that other types of stablecoins and the ones backed by fiat money don't exist. For example, algorithmic stablecoins are very interesting and shouldn't be overlooked due to fiat-backed stablecoins. Before closing the session, I would like to inform you that the DC³ conference continues on 27th January, where we have 3 sessions for the security track. You can see the details on the screen. So the morning session will continue with a fireside chat sessions on digital currency notions, following the discussion on the security and privacy aspects of digital currencies, and finalizing with a deep dive session on the digital currency validation for protection and resilience. I would like to take this opportunity to thank the panelists for their participation in today's session and sharing their insights on the topic. And I would like to wish you a pleasant day and thank you for your attention. All the best. Thank you. Bye-bye.
Thanks, everybody.
Bye-bye.